Hi, my name is Stuart and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And as usual, I'm going to keep plugging this live Q&A. In fact, it's the last time I do this because on Monday, Campbell and I at 8:30 are hosting a live Q&A on YouTube. Please register to watch this. You can register. The link is in the show notes. The URL is investopoly.com.au/live, but the link is in the show notes. I hope to see you there. Okay, let's get into today's episode, and it's all about capital gains tax discount changes. Now, the Senate committee released its report yesterday. I'm recording this before the 17th of March, so I don't know what the report says or what the government's response to it is, but I do have it on good authority that the government is planning to reduce the CGT discount to 1/3, so 33%, that they're going to introduce a cap on the number of investment properties that can be negatively geared. I've heard the cap is 2 properties, could be 3, but I've heard 2. And most importantly, or surprisingly really, is that, as I understand it, there's no grandfathering on the capital gains tax discount. So it's unavoidable. Now, that's what I understand from, I think, reliable sources, but that doesn't mean that's exactly what's going to happen or what is legislated, or what will be legislated, I should say. So we can't react to it too much. And in fact, that might be the government's plan right today, but until they make the announcement, until they release the budget, none of us are going to really know, which is at the start of May. None of us are really necessarily going to know what the changes might be. So let's not jump at shadows, but I think it's reasonable to expect that there is going to be some changes to the CGT discounts. And that's what I really want to talk about today in today's episode. How does it impact you? How does it impact property investors? How does it impact strategies? And what potential workarounds could there possibly be, subject to, seeing all the rules and legislation and so forth? Okay, so let's sort of take a step back and understand what got us here. So the Greens were the party that really pushed for this Senate committee into investigating how the CGT discount operates and what impact really it has on property. And really, the Greens have 3 main concerns or claims with respect to the CGT discount. They think, firstly, it inflates housing prices. And the argument is that it attracts more investors into the market and investors compete with owner-occupiers. Well, independent modelling from the Grattan Institute concludes that tax settings like CGT and negative gearing can be price inflationary, but only at the margin. So the dominant driver, as we all know, logic tells us it's supply and demand. It's the structural imbalance of population growth and us not building enough houses in the locations required to satisfy that population growth. And that's what pushes prices higher. Tax has an impact, but certainly only at the margins. The next criticism of the CGT discount is that it mainly benefits the top 1% of wealthy Australians. So the Greens claim around 60% of the benefit of the CGT discount goes to the richest 1% of Australians. And that data is actually being verified by the Parliamentary Budget Office, and that the PBO is independent, or supposedly independent to the government of the day. So we have to take that information at face value. I mean, the other way to say that is that the richest 1% of Australians pay 60% of the CGT tax liability. So, of course, they're getting the benefit, but they're also paying most of the tax. The 50% is a flat discount. So it shows who's paying all the tax. And if we reduce the discount to 1/3, they're still going to get 60% of the benefit. So it's not going to move the dial if you change a flat discount rate. So it's a popular statement to make, I guess, from a political party perspective, because it's attacking the rich, whereas most people, 99% of Australians, it's not attacking. So I can understand the reason for framing it like that, but, it's not quite correct. And finally, the Greens suggest that the cost of the 50% CGT discount is $247 billion over the next decade in terms of lost revenue. And they say that money could be spent funding social housing, social and affordable housing, for instance. So how they come up with that 250 odd billion dollars? Well, firstly, the 250 billion dollars assumes the discount is removed entirely, so there's no CGT discount. And probably the most aggressive assumption is that there's no material change in behavior as a result of the reduction of the CGT discount, or removal, I should say. Now, of course, if there's no discount and you're going to be taxed on any change in actual value, including the inflationary impact, of course, most people aren't going to invest in property. And of course, that $250 billion is nonsense. But again, it's a good headline, and most people would agree that's a lot of money. And maybe Australia could do something a little smarter with that money. Now, I'm not sharing this information because I want to make this podcast political. In fact, quite the reverse. I want to focus on evidence-based strategies and assessment and analysis rather than bore you with my political commentary. So I'm not doing that, but I just wanted to bring some evidence to some of these claims, because some listeners might be sitting here thinking, well, why are we reviewing the discount? And, what got us here? Well, that's the political rhetoric, if you like. A lot of it's flawed. All 3 points are really flawed, in my opinion, based on the evidence. But anyway, we're here today and we're probably going to be faced with some changes. The criticism that the 50% discount is too generous does have some merit. So CGT was introduced in 1985, and when it was introduced in 1985, you used to have to index your cost base to CPI, so that you were only taxed on the gain between the real value change rather than the nominal value change. That is, you're not going to pay tax on inflation, the inflationary change of the asset. And that was changed in 1999 by the Howard government, and they introduced the 50% CGT discount to promote people, investing in Australia. So to reduce, capital gains tax essentially, but also to streamline the old model of applying CPI with just a little bit more work. Probably not a big issue today with technology and systems and AI and so forth. But back then, you had to do a manual calculation. So it was a bit more cumbersome, and just to cut a bit of red tape, they made a 50% discount. If you look at how that compares to the old indexing CPI model, it is more generous. The break-evens, it's hard to measure because inflation's different, but break-evens are around about 40%. So if they reduce the discount to 40%, that would be broadly in line-ish with what the old CPI system. So the criticism by any political party that the 50% discount is too generous has merit. There's comparing to CPI, yes, it is in many circumstances more generous. Now, the problem with this is you're not necessarily going to fix supply. Well, it's not going to really change supply. In fact, all you're potentially doing is dissuading people from investing in property. But the problem is that you're probably going to hurt a policy, a tax change that makes investing in property less attractive is probably going to harm the cohort that can afford it the least. The reality is that if you make investing in property less attractive from a taxation perspective, holding everything else constant, it's reasonable to assume fewer people will want to do it. Now, the problem is around about a third of Australians rent, and that hasn't really changed over many decades. The proportion of renters, it's increased a little bit, but not by huge amounts. The reality is not all renters want to own a home one day. Many do, of course, but some people rent for different reasons. That might be their preference. They might not want to buy a home in that particular location. They may never, ever be in a situation financially to buy, for instance. There's going to be a large cohort of renters. The other challenge is that private investors supply 85% of rental dwellings in Australia. So Australia, from a housing perspective, is reliant on private investors to supply, as I said, more than 80% of housing. And this is, you might talk about new housing, but not everyone wants to live in a new build area. Some people want to be able to rent a property, in a blue chip suburb, for instance, and that's really where they want to live. Well, we need to make sure that there's enough private investors that are providing rental accommodation in those locations. So what's going to happen in those locations? Well, there's going to be fewer private investors because there's a disincentive from a taxation change perspective. There's the same amount of renters or very close to it. You're not really going to move the dial too much in terms of people going out and buying a home as a result of the tax changes, especially if the Grattan Institute's modelling is correct that it really doesn't change prices. And because there's a reduction in private investors, rents will rise. Now, I'm going to talk about the UK example as a bit of a very useful case study of these sorts of taxation changes and the impact. But ultimately, the Greens are going to, their idea around changing the CGT discount is actually going to hurt the people they're trying to protect at the most. But anyway, this is not a political statement. It's an observation about the mechanics of the property market. Okay, so I've run some numbers. So I would imagine everyone that's been listening to this podcast or anyone listening to this podcast for any period of time would have just assumed I'm going to run the numbers on it as an accountant by trade. Of course, I'm going to dig deep into the numbers. Okay, so what I've done is I've modeled the old CPI methodology, so what that was present or how it applied between 1985 and 1999. I've modeled the current 50% CGT discount, and I've modeled a hypothetical discount at 33%, so 1/3 reduction of the gross capital gain, which is what I understand is proposed. The key assumptions underlying my analysis is 6% capital growth rate, which would be a reasonable assumption looking at long-term data, and 3% for inflation for CPI. Again, that's pretty much in line with more recent history. So I think those assumptions are pretty defensible. And so what I've done is I've calculated the effective tax rate over time. Because of course, with a flat discount, the effective tax rate doesn't change no matter how long you own an asset. But with CPI, the effective tax rate does change. So of course, with a flat discount, the effective rate remains flat. So currently the effective rate, the maximum effective rate, is 23.5%, which is half of the top marginal tax rate of 47%. So you'll pay 23.5% of your gain out in tax, and you'll keep the remaining 76.5%. Not bad. If the discount is reduced to third, so 33%, your effective tax rate will be 31.3%. Now, the old CPI model is a bit different. The effective tax rate increases the longer you own an asset for. So the effective tax rate, based on my modelling, starts at 23.5%, which is exactly what it is today under the 50% discount. But the longer you hold the property, the higher the effective tax rate. So if you own a property for 40 years, you'll end up paying 35.6% in effective CGT rate. And the break-even crossover period is about 25 years. So you hold it longer than 25 years, you're worse off even to the potentially proposed 1/3 discount. So certainly the CPI mechanism, it was a bit of a double-edged sword. In one hand, it disincentivized long-term capital. So it disincentivized people to hold property for the very long term. On the other hand, it's the people that have held property for many decades. Like if you bought a property 40 years ago, chances are you're sitting on a lot of equity and you can afford to pay a slightly higher rate of tax. So much like our marginal income tax rate system, where the more you earn, the higher the rate you pay because you can afford to pay more. Sort of similar with the old CPI model as well. And I guess you can turn that criticism on its head with a flat rate of CGT like we've got at the moment with a flat discount, is that there's no incentive for long-term capital. You'll pay the same rate of tax if you go and buy a property and hold it for 2 years, flip it, make a quick profit, versus if you're providing, rental accommodation to the Australian renters for the next 20 or 30 years, you're paying exactly the same rate of tax. Also, if you play around with the growth rate, the capital growth rate, the effective tax rate for indexation also changes. And of course, that makes sense, right? Because the gap between CPI and the growth rate, the wider that gap is, the more tax you're going to pay. So at a 5% capital growth rate, the effective rate's going to be between 19 and 30%. But at a 7% growth rate, the effective rate's going to be between 27 and 40%. So again, the indexation model did work to some degree because the more capital, the more compounding capital growth you enjoyed, the higher the effective rate of tax. Now, I'm not advocating for that. I'm just looking at the systems and how they behave over a long period of time. And in terms of framing the criticisms of the current 50% CGT discount, and if they just move the discount, they're not really changing how this tax behaves in certain situations. Anyway, let's deal with reality. The reality today is the maximum effective tax rate is 23.5%. And if they reduce the discount to one third, the maximum effective tax rate will be 31.3%. So you end up paying effectively an effective rate of 7.8% higher than we'd otherwise pay today, or third increase in the amount of tax that you pay. So a 33% tax hike. Now, on the face of it, that seems like a huge tax hike, and it is. I mean, I'm not saying it's not a huge tax hike, but what I wanted to do is consider, well, what impact does that have on investing in property? To what extent does it move the dial? And arguably, if you're going to invest in property and now you have to pay more tax, to hold things constant and achieve the same after-tax return, you actually need to generate a higher pre-tax return to offset this higher cost of tax. So to what extent can you do that? And I guess that's really the focus. In a more aggressive tax environment, we really do need higher returns to justify the same investment outcomes. Anyway, I had a look at sort of two measures. The first measure is the internal rate of return. And the internal rate of return tells us the after-tax return I've earned on the cash flow that I've contributed towards the property. Now, most investors borrow 100% of the cost of investing in property, so we don't put any cash in at the beginning. Our out-of-pocket contribution towards this investment comes from funding the negative cash flow of the property over the entire ownership period. So the internal rate of return then is really the return generated on that capital that the investor has progressively contributed towards the holding costs over their ownership period. That's a percentage return. Of course, the more money I put into the property, holding the internal rate of return constant, the better the more dollars I return. Just like if you put, the more money you put into a term deposit, holding the interest rate the same, of course, in dollar terms, the more interest you get paid, just because the principal's higher. So it can be, an internal rate of return is good to measure, one property asset to the next. But in terms of measuring the impact on your wealth, it's not necessarily the best measure to use. The best measure to use is net present value, and that's the second measure that I use to measure the impact of these potential CGT changes. And the net present value essentially reflects the current value of all after-tax cash flows resulting from investing in a property. So put simply, it's in today's value what you end up with after selling the property, in my modelling, after 30 years, after subtracting how much the property has cost you to hold. So, of course, I invest in property. I know I've got to pay out $20,000 this year. It'll be $20,000 next year for the negative cash flow. Then one day I'll sell the property 30 years from now, and, net of paying for CGT and repaying the loan associated with the property, I might walk away with $2 or $3 million. So what is the present value of all those cash flows, both the negative holding cost and the positive sale price? And really, net present value is really how much will a property generate from holding it in dollar terms. And that's why I think it's the most important measure, particularly from a financial planning perspective, because at the end of the day, it's all about building wealth, personal wealth. And it's all about accumulating as many dollars as possible, because that's how you're going to fund retirement. Of course, you need to pay for living expenses. You pay for living expenses with dollars, not percentages. Okay, so here's the results. In terms of the internal rate of return, it declined by 0.5%. So the internal rate of return, the current, based on current tax settings, was 12.6, holding everything constant, just changing the tax, it reduced to 12.1. So it's about a 4% decline, 12.6 versus 12.1 internal rate of return. On those metrics, you'd go, it's not too bad. It's not really moving the dial. I mean, a 12% return on your money after tax is still a good outcome, and it is still a good outcome. But let's measure the impact in dollar terms. So the net present value decreased by 12% or $180,000. So the net present value went from 1.535 million, so 1.5 million, to about 1.3 million, 1.35 million, sorry. So a 12% reduction in the amount of wealth on an after-tax basis you can generate by investing in property and holding that property for 30 years and dealing with, this is not accounting for the time that you contribute towards the decisions and managing that property and so forth. A 12% reduction is significant. But I think the case for borrowing to invest in property still largely holds. The strategy primarily works because of the leverage, and you're benefiting from hopefully the compounding capital growth if you buy an investment grade property. And those forces still make property investing attractive, less attractive than what they used to be if they do go ahead and change the CGT discount, of course, but still attractive as an additional tactic to help you build wealth in addition to things like investing in shares and, of course, superannuation. Now, in terms of my key assumptions around the modelling, just quickly, I assumed a $850,000 investment property borrowing 100%, a starting gross rental yield of 4%, and ongoing property expenses of 35% of gross rental income. And I've assumed rental income grows each year by 4% and the property value grows by 7%. I think all those assumptions are very defensible, rational, and logical and conservative or reasonable. But of course, if you change any of those assumptions, of course, the outcomes would change as well. The key thing here is I've held all those assumptions constant, and all I've done is just change the taxation element to it. So I've really just isolated the impact of taxation. Okay, the next thing I wanted to do is model what would happen if they changed the CGT discount for property but didn't change it for the share market. To what extent does that make investing in shares more attractive? Well, to compare apples with apples, I modeled using the same return assumptions. So in the previous model, I used 4% rental income and 7% capital growth. I use that for shares as well. Now, 11% a return for shares, I think, is more aggressive than it is for property. And the reason for that is just return sequencing and volatility. Of course, share market is twice as volatile as the Australian residential property market. And so to reflect that risk and higher volatility, I think we should assume lower returns. Now, I know that's not comparing apples with apples, but just from a financial planning perspective, I think that is the most prudent. But in this scenario, I want to compare apples with apples, so let's hold things the same. Same gearing, same return. The only thing we're changing is that the 50% CGT discount remains for investing in shares. Now, the net present value ended up being $2.3 million. And remember, that's $2.3 million versus $1.5 million for property, or 1.35 to 1.5, depending on which tax structure you look like. So certainly investing in shares is more attractive. And the only reason for that is that we held the income constant. And so the share portfolio, because it's generating the same gross income, I should say, but there's no associated costs, whereas there's associated holding costs with property. The portfolio became positive cash flow after only about 8 years, whereas the property portfolio was negative after a long period of time. So comparing apples with apples, you go definitely shares, but I think we've got to look at more realistic comparisons in terms of assumptions, noting that if the total return assumptions are different, then I aren't comparing apples with apples. So I just want to point that out, but I'm okay with that. I'm happy in terms of doing a meaningful analysis, a more practical analysis. I'm happy to make sure those return assumptions are different. So if I assume, say, a global index, then I'm going to assume 2% income and 8% capital growth. That's a 10% total return, so only slightly lower than the return I looked at previously, but I'm lower income because it's a global index. 10% is the long-term average. You'd still say from a modelling perspective, that's still slightly more aggressive. I normally like to go with a 7% total return rather than 10, but again, I'm just trying to compare sort of like with like to some degree. Well, the net present value ended up higher, $2.4 million. And the reason it ended up higher is because of the higher compounding capital growth rate, lower tax drag on the portfolio because I've got less income, more negative gearing benefits, and under these assumptions, the portfolio remained negatively geared for about 16 years. So very similar to sort of the property portfolio, for instance, from a cash flow perspective. Now, these modelling comparisons assume that someone's willing to go out and borrow $850,000 and invest it into the share market, in one lump sum or at least relatively quickly, just in the same way someone will go out and borrow $850,000 and go and buy an investment property. Now, I will talk about that. I'm going to record an episode about lump sum share investing versus investing in tranches or phases over several months. and obviously share the evidence with respect to that. So I don't want to talk about that today. Let's just park that issue about, borrowing a large amount of money, investing in the share market. It's something that, I've changed my view on actually over the last sort of 5-ish years. And I just want to sort of unpack that for you. I'll do that at the beginning of next month. But I think what this analysis tells us that if they change the CGT discount for property but not shares, shares become a materially more attractive proposition, particularly if the portfolio is structured correctly, the share portfolio is structured correctly. And let's not forget, when I'm looking at the CGT and doing the net present value calculation, I've assumed that we'd liquidate the entire share portfolio in 1 year. That's almost certainly not going to happen. The benefit with a share portfolio, remember, is that I can progressively sell down over many years, thereby spreading, because it's taxed at our marginal rates, thereby spreading and minimizing the tax liability. So if I imputed that into the calculations, the gap between property and shares would be even more stark. Now, almost this time last year, I released episode 350, where I talked about potentially using a company to hold a property investment. And I lay out a strategy or structure where you can still benefit from negative gearing, but then trap the capital gain inside a company. And the benefit of trapping the gain inside the company was that you could then pay out dividends over a long period of time and essentially spread the liability of that capital gain over many tax years, as opposed to if you sell a property in your personal name, it's going to occur all in one tax year and then give rise to more tax. And I modeled the outcome in that blog and podcast episode. And I assumed that if you could spread the gain out over a 16-year period, so sell it today, then pay dividends over the next 16 years, you could reduce the effective tax rate to around 14%. And that would hold true even if they change the CGT discount, because companies don't actually get the CGT discount. So any change isn't going to affect investing in a company. Now, it's important that you get advice, because this is information only, always is, never advice. So it's important you get financial and tax advice in regards to this. It's important that the transaction is structured correctly. There could be some challenges with financing, particularly as banks have certainly more recently tightened up around financing through structures such as companies and trusts. But it's very doable. Whether the government will, accommodate this through their legislation, so try and trap this arrangement, I think it's unlikely, but whether they do, time will tell, but that could be a potential solution. I guess the lesson here is, and it was a lesson with Div 296 tax as well. Div 296 tax was the tax on super accounts worth more than $3 million. Remember, this has been debated over the last few years, and people started to take money out of super. Now, they dramatically changed that legislation for the better in terms of for the taxpayers' favour. So I think the key point here is, let's not jump in shadows. They haven't changed anything yet. Until it actually becomes law, we don't know what we're dealing with. So I wouldn't make any changes or jump to any conclusions. But of course, once all these things play out, I'll be covering them in this blog. But I guess the point that I'm trying to mention here, and which I mentioned in episode 350, and there's still, even in the absence of some changes to CGT, there's still some benefits associated with this structure to my mind. The point that I'm trying to make is that, there could be workarounds or things that we can do to minimize the impact on our strategy with respect to these changes in CGT. Okay, the final thing I wanted to finish on today was a bit of a case study, using the UK market as a case study, because the government has interfered in the property market in the UK under the guise of trying to help affordability, but essentially it's squeezed out private landlords, made investing in property less attractive. So I just wanted to mention this. I'm going to share what changes they've made and what the impact has been, because I think it will kind of set the scene or expectations for what we as property investors might expect over the coming years. So firstly, the first change that the UK made was to reduce the amount of interest you could deduct. So really reducing the negative gearing benefits, and they capped that deduction at 20% of your interest cost. So in Australia, if you're on the highest marginal tax rate, you'll get a 47% interest deduction. In the UK, they reduced that to 20%. So if you're talking about in Australian terms, you're only getting sort of half the deduction for interest compared to what's happening in the UK compared to what's currently present today. So they watered down negative gearing. The second is they introduced stamp duty surcharges on second homes and buy-to-let purchases. So that really put a clamp on the number of transactions that were happening. So if you wanted to go out and buy a holiday home or something like that, you're going to pay much, much higher stamp duty. And third, they tightened tenancy rules, much like, a lot of tenancy rules in Australia over the last 5 years have been tightened substantially. The amount of changes to the Tenancy Act are in the hundreds, really, over the last period of time. So it's probably not that different to here, but they now want tenancies to be more open-ended. So there's no fixed term tenancies like there is in Australia. Normally, tenancy agreements are 1 year. They last for 1 year and then they're renewed. These are evergreen in the UK, as I understand, and they restrict the landlord's ability to end that agreement. So that's called a no-fault eviction, and they're being wound back in terms of when you can evict a tenant. And really, the three situations are the landlord's going to sell the property, they're going to move into the property, or there's got to be a serious breach of the tenancy agreement. And the notice periods for tenancies have changed in the UK as well. So really, in essence, more risk for the landlord, less flexibility, and less confidence around your property and your property's income profile. And together with the tax changes and the higher transactional costs, higher regulatory risk, all that sort of stuff, it's not surprising that private investors have been exiting the market and the supply of rental properties has been shrinking. In fact, I saw some data in 2025 calendar year that an average of 21 prospective tenants applied for every single available rental property in the UK on average. And rents have risen by 18% between 2017 and 2023. And here's the kicker. Home ownership rates haven't materially moved in the UK. So if this is all about getting more people to own their own home, it certainly hasn't worked. All it's done is harm renters, really, and harm investors, although those investors can move their capital elsewhere. As an investor, you don't have to invest in the property market. You can go and put it in the share market. There's lots of things we can all invest in, so we don't have to. But renters need a home to occupy. And so to my mind, it hurts renters more. As I said, investors have other alternatives they can pursue, but it's the renters that suffer the most. Okay, so to sum it all up, if the government reduces the CGT discount, it will certainly reduce the effectiveness of borrowing to invest in property as a wealth accumulation strategy. But it's probably unlikely on its own to make the strategy completely unattractive. But for investors that are more comfortable to borrow to similar levels and are able to deal with share market volatility, then investing in the share market is going to be comparatively more attractive if we assume that they don't change the CGT discount for investing in shares. It only applies to property. But of course, to do that safely, we need to make sure that the portfolio is constructed appropriately. And as I said, I'm going to talk about that at the beginning of next month in terms of making lump sum share investments and funding that from borrowings. So that's from the investor's side perspective or side of the coin. Let's look at what happens to Australia. Well, it's almost certainly a policy change like this. And if you look at the UK as a really good comparable example, it's unlikely to change home ownership rates. The only thing that's likely to change is it's probably just going to put pressure on rental incomes. And rentals will be pushed higher even after the inflation that everyone has experienced after COVID. I guess the other side of that coin is for investors that hang on, that ride that market out, that still have investment properties. The good news is there's probably going to be pressure on rental income, so your income profile will be improved. But unfortunately, I think it really harms people that can least afford it. So there you go, a bit of a longer one today. It's a really important issue, and stay tuned to the podcast because there's no doubt I'll be doing more work on these changes when we become aware of them once they are sort of locked in. I'll always be covering in this podcast. And just a friendly reminder to register for the YouTube live event on Monday at 8:30. Hope you can tune into that. Just register. The link is in the show notes. And until Monday, I'll talk to you then. Cheers. And before you go, if you enjoyed this episode, please share it with someone that you think will get value from it. And if you have a moment, leave a rating or review on Apple Podcasts or Spotify, as it really helps more people find the show. If you have a question you'd like me to answer in the next Q&A episode, email it to questions@investopoly.com.au. And if you'd like to learn about my new book, Wealth by Design, which is out in a few months' time, head over to investopoly.com.au/book. The link is also in the show notes. And you can also register for the pre-order offer, which is an AI tool that you can use to get more personalized value out of this podcast. Thanks for listening.